Welcome into the Informed Investor Long-Term Thinking Weekly Insights. It's a mouthful. It's a new name. We're trying to give you some new ideas and some new thoughts. Speaking with me today is Adam Phillips, Managing Director of Investments at EP Wealth. I always like to start with a performance update. The Dow Jones Industrial Average year to date is up 3.19%. The Dow Jones is leading the market, and we're 2 months done with the year. It's flying by. The S&P 500 up 1.2%, but that's where things get a little bit shaky. The S&P mid cap down 0.8%. The Nasdaq down 2.4% year to date, and the Russell 2000 really kind of the underperformer, down 3%. But we had a month of January that was positive and a month of February that was negative. We've had a little bit more volatility. We're going to talk about that and much, much more. But let's start with his thoughts on performance updates, and we'll switch into tariffs. We'll switch into rotations. We'll switch into the jobless numbers later on in this segment. Adam, any thoughts on performance year to date? What is it telling us?
Well, look, Rob, I think we came into this year expecting things to be a little bit choppy, and that's what we've seen. What we are seeing underneath the surface is the Magnificent Seven is down about 10%, so in correction territory
Wow.
from its all-time highs. But at the same time, we're seeing other parts of the market respond pretty well here, and so I think there's this question of, is this a correction? Or is this a rotation? And so I think the jury is still out. So far, we're hopeful based on what we're seeing that this is more of a rotation, even though some of those bigger names that have been leadership for so long are lagging. We're seeing other areas of the market start to catch up. And I think that's really, really favorable to see. Now we're watching the data very closely, and we expect this volatility to remain with us. But yeah, I mean, so far, I would say that the market is starting off the way that we expected, coming off some really strong years with fairly low volatility. Coming out of the election in November, we saw animal spirits were running high. Whether you were happy or not with the result, I think most agreed that this was going to be good for most financial assets. This deregulation, potential of fiscal stimulus and the extension of tax cuts, perhaps more tax cuts for corporations. So these were positives. Now we've seen this uncertainty injected into the environment, and so that's leading to a little bit of anxiety among investors. So what I would say right now is it's a fragile market, but one that's holding up so far.
Okay, so you're not seeing anything sinister like the tariffs and some of the things you talked about, the tax breaks that could come later in the year. But the tariffs, March, you know, beginning of March, Tuesday, what we will learn on Mexico's tariffs versus Canada's tariffs versus China's tariffs versus other countries. There's some question marks there for me. So I know a lot of our viewers have question marks there for you. Is this sinister tied towards the tariffs, or is this, I don't know. Why don't you just talk about tariffs a little bit and
Sure.
current market conditions?
Look, I have my own questions when it comes to tariffs. I think most of us do, and
Okay.
so this is basically this 30-day delay in the tariffs. It expires tomorrow, which is March 4th, and so as it stands right now, the U.S. is going to move forward with tariffs of 25% on both Mexico and Canada, and but a 10% tariff on energy products coming out of Canada, and then an additional 10% tariffs on top of what has already been announced on China. So if you look at market activity, it seems that most investors are still going with the assumption or the hope that this is a negotiating tactic, that there will be some kind of last minute resolution or maybe a delay. And so we've already heard Mexican government kick around, okay, maybe we will add our own tariffs or trade restrictions on China, and maybe that helps us to avoid these tariffs coming from the US. We'll see. I think this is going to come down to the wire. If these actually get put into place, I think what you might see is that the market come to grips with reality, and maybe we do see some additional downside volatility. What we're also on the lookout for is retaliation from major trade partners, and so I think we're about to find out whether this is all talk and whether it's mostly bark and not bite. But I think that's what investors are clinging to. I think that right now they're leaning towards the idea that this is really tough talk, though. So they could be in for a rude awakening from here, but we'll see. As it relates to if these get implemented, I've been asked a lot about, well, what's our game plan if these do get put into place? And really, so far, there really hasn't been much action to take because we just aren't going to respond to every little headline. We can't pretend to know how this is going to shake out and what it's going to look like once the dust settles because we don't know how much is simply negotiations. So we're going to be watching for what policy changes actually get put into effect, and then we'll start to think about what the economic consequences are, who the winners and losers might be. I will say that this could produce some sort of a growth shock or at least some kind of a growth headwind to the U.S. economy. On the inflation side, I think we're generally in the camp that tariffs are inflationary. They are a tax on consumers, on buyers. The reason it's a little bit different this time is that the consumer is in a very different spot than they were 8 years ago. We are seeing the job market start to tighten a little bit and show some signs of weakness. We could talk about that in a few minutes. And so what we might actually see is that consumers are actually going to push back on higher prices. And what this might actually do, instead of just taking it on the chin and rolling along with it, they might actually say no and curb demand. And this could actually be disinflationary if that happens. So I think the growth call or the growth impact is a little bit easier for us to determine. The inflation side, not so much. So we'll be really interested to see how this all plays out.
Good stuff. Now you talked about um, you and I talked a little bit off before we got on about the Atlanta Fed projection, and I'm a little confused on what is an Atlanta Fed projection and why should I care as an investor? Um, what do we need to know about this?
Well, the Atlanta Fed produces what they call the GDP now. It's a forecast or what they call the nowcast, and it's kind of a running tally of where they expect that current quarter's economic growth to be. Historically, it's been pretty good. It's updated throughout the quarter, and it becomes more and more accurate as the quarter goes on because they have more data to feed this estimate. And so we're about two-thirds of the way into the first quarter, and so this is going to be updated more as we get closer to the end of March. But what happened last week is we saw the estimate for this quarter's GDP fall from just over 2% to actually negative 1.5%. And as of this morning, it's actually even lower, negative 2.8%, suggesting the economy is actually going to slow and contract in the first quarter. Now, I don't necessarily think that most investors are watching this. We think it's interesting and something to keep an eye on. And certainly the print or this updated estimate caught our attention. But I think it's really important to explain what actually is moving the needle here and why we are going to take it with a grain of salt.
Okay.
It's really reflective of the fact that because of the uncertainty, we're seeing businesses pull forward spending, pull forward imports, and just to get ahead of the tariffs because they don't know how the environment will change here in the coming weeks and months. And so that's really what explained a lot of the move here over the last week. We saw net exports, so how much we are exporting versus importing as an economy. So net exports, it feeds into the GDP calculation, and that changed quite a bit because our exports were kind of held steady while our imports just skyrocketed based on last week's trade report. And that really just reflects companies trying to get ahead of tariffs and bring a lot in before tariffs go into effect. And so we'll see whether this continues or if it was a one-off. But that's why we're not too concerned, even though some measures within the Atlanta Fed suggested that the consumer is slowing down in terms of spending as well. So, all it is, Rob, I would say this just goes back to the fact that we are seeing signs of a weaker economy. It doesn't necessarily mean that a recession is on the horizon, but it has our attention because this goes back to something that we've been talking about more recently, which is that idea of stagflation. It's an economic condition where you have a stagnating economy and inflationary pressures. And so it just makes it's a, excuse me, it's a very hard environment for the Fed to navigate. When we know it wants to cut rates, it probably can't do that if inflation is still a problem. So anything that suggests that the economy is weakening or softening or could soften further, meaning through tariffs, that gets our attention.
Okay. I've done a lot of these with you and I keep learning. Jobs are important. Inflation's important to look at. Stagflation's become important. I think that goes through a cycle or something like that. Earnings, it's all parts of the puzzle. And I'm glad you like doing puzzles because you do a nice job of explaining this to us. Let's talk about that part of the puzzle, the jobs. If people have jobs, they tend to spend paychecks. We hear about paycheck to paycheck. If people have jobs, they tend to be able to service their credit. So it is important to pay attention to. The jobless claims on Thursday are coming out, and I think we're at the start of a new month, so we're going to get new jobs numbers as well. What's your pulse on the jobs market right now to support all of our spending and our credit?
Well, we've seen evidence that the jobs market is softening up here, and we're not seeing mass layoffs, but we are hearing about them more. Let's put aside the government jobs for now,
That's
because
convenient.
I know that's exactly where your head was going. But we're seeing other companies, well-known companies, announce some layoffs here, and so it's not enough to really move the needle so much here just yet. But what we were seeing in over the last few months is the fact that even though we weren't seeing layoffs surge, we were seeing hiring slow. And so
Okay.
that is kind of a precursor to potentially layoffs, more layoffs, and because that demand for labor is falling. So that is something that has our attention with this report on Friday. With the February jobs numbers, we expect the unemployment rate to remain around 4%. And we'll see what the net change to total payrolls in the U.S. Is going to be. Is it going to be around 150,000? That would be a fairly decent number. Does it surprise to the upside or to the downside? We'll see. But in this environment where we are becoming more sensitive to the threat of some economic slowdown, I don't want to say the R word, that we're going to focus on this quite a bit. You mentioned that jobless claims number. This is a weekly number that we get. We get it every Thursday. Last week's jobless claims number was actually the highest print since October. And it can move from week to week, and for that reason, we look at it on a 4 week moving average basis, and it is trending higher. And so it just means that we don't want to get too worked up over last week's print, but we want to see what this next one is. And it's really just reflective of people that are out of work and they need to file for unemployment benefits. Oftentimes, it's not going to capture those um, that are out of work, or displaced from their job, but they have a severance package. They can't qualify for unemployment benefits. And so in some cases, it's not going to capture everyone, some of those government employees, some of those from major companies that have announced layoffs that I mentioned, but it will pick up everyone else. And so it is something that we do want to watch.
Thanks very much. I think you've done a great job. I do know we are off next week, so I want to remind people who are watching it's a good time to talk about finances with your financial team. Don't be shy about that. Stay on top of everything. I know tax season's also coming up, which is not to be said out loud, but no one likes doing taxes, but it's coming up. So talk to your financial team. I'm Rob Black for the Informed Investor Long-Term Thinking Weekly Insights. New title. It's a little bit longer, tougher for me to get out. He's Adam Phillips, Managing Director of Investments at EP Wealth.